Adani Group, India's infrastructure empire built on debt. In the sprawling port city of Ahmedabad, Gujarat, a young diamond trader named Gautam Adani made a decision in 1988 that would reshape India's infrastructure landscape forever. With just $15,000 in startup capital, Adani abandoned the glittering world of diamonds to bet everything on a commodity most people barely noticed: the coal, ports, and power that make modern civilization possible. What followed was one of the most audacious empire-building stories in modern business history, a 3-decade journey that would see Adani transform from a modest trader into the architect of India's largest infrastructure conglomerate, wielding over $200 billion in assets across 6 continents. This is the story of how political acumen, relentless debt leverage, and an unwavering focus on infrastructure bottlenecks built an empire that powers nearly 15% of India's electricity, handles 30% of its cargo, and feeds coal to hundreds of millions of homes. But it's also a cautionary tale about the razor-thin line between visionary empire building and dangerous financial engineering, where fortunes worth over $100 billion can evaporate in days when markets lose faith in debt-fueled growth. Gautam Adani's path to infrastructure dominance began not with grand visions, but with sharp observations about inefficiency. Born into a middle-class textile family in Ahmedabad, Adani dropped out of Gujarat University in 1978 to work in Mumbai's diamond polishing industry, where he learned the art of identifying value in rough commodities. But it was his return to Gujarat in 1988 that marked the real beginning of his empire. Starting Adani Enterprises as a commodity trading company, he initially focused on agricultural products and textiles. But Adani quickly recognized that India's economic liberalization was creating massive infrastructure bottlenecks. While other entrepreneurs chased consumer goods and software exports, Adani saw opportunity in the unsexy but essential business of moving things, importing coal from Indonesia, building storage facilities, and solving the logistics nightmares that plagued Indian industry. His first major breakthrough came through political connections in Gujarat, where his relationship with rising BJP leader Narendra Modi would prove instrumental. When Modi became Gujarat's chief minister in 2001, Adani was already positioned as a key infrastructure partner, having built relationships that would sustain his expansion for decades. By 1994, Adani Enterprises was generating $50 million in annual revenue, but Adani understood that in infrastructure, scale wasn't just an advantage, it was survival itself. The blueprint for Adani's empire crystallized around a deceptively simple strategy: identify infrastructure choke points, acquire them through aggressive debt financing, then leverage those assets to expand into adjacent sectors. His first major coup came in 1995 when Gujarat's government awarded him the contract to build and operate what would become Mundra Port, a decision that seemed almost impossibly ambitious for a company with barely $100 million in assets. Conventional wisdom suggested that ports required decades of patient capital and gradual expansion, but Adani understood that India's economic growth was creating urgent demand for cargo capacity. Using a combination of debt financing and political support, he began construction on Mundra with the vision of creating India's largest commercial port. The project required over $5 billion in investment over 15 years, money that Adani didn't have but was confident he could borrow against future cash flows. This became his signature approach: identify assets that would become indispensable, acquire them with borrowed money, then use their cash flows to finance the next acquisition. By 2009, Mundra Port was handling over 60 million tons of cargo annually, making it India's largest commercial port and generating the cash flows that would fuel Adani's next phase of expansion. The port's success validated Adani's core thesis: in a rapidly growing economy like India's, infrastructure assets with natural monopoly characteristics could generate returns that easily justified aggressive debt financing. Power generation became Adani's next frontier, and here his appetite for debt-fueled growth reached breathtaking proportions. Recognizing that India's economic expansion required massive increases in electricity generation, Adani Power was established in 2006 with plans to build some of the world's largest coal-fired power plants. The numbers were staggering. The Mundra Ultra Mega Power Project required over $4 billion in financing to generate 4,000 megawatts of electricity, while the Tiroda plant in Maharashtra needed another $3 billion for 3,000 megawatts of capacity. Adani's approach was characteristically aggressive. He would simultaneously develop multiple gigawatt-scale projects, financing them through a complex web of rupee and dollar-denominated debt that eventually exceeded $20 billion across his power portfolio. The strategy worked brilliantly during India's high-growth period from 2006 to 2012, when electricity demand was growing at 8% annually, and power purchase agreements with state governments provided guaranteed returns. Adani Power became India's largest private thermal power producer, generating over 13,000 megawatts of electricity and supplying power to over 100 million people. But the power sector also revealed the risks of debt-heavy expansion in regulated industries. When India's economic growth slowed after 2012, many state electricity boards struggled to honor their payment obligations, leaving Adani Power with billions in receivables and debt service obligations that would strain the entire group's finances. The coal business represented Adani's most audacious bet on vertical integration, a strategy that would eventually span 3 continents and generate fierce environmental opposition. Understanding that his power plants required reliable coal supplies and that India's domestic coal production was dominated by the inefficient state-owned Coal India Limited, Adani began acquiring coal assets globally. The crown jewel was the Carmichael coal mine in Australia's Galilee Basin, a project that required over $10 billion in investment to extract coal from one of the world's largest untapped reserves. The Carmichael project embodied everything audacious about Adani's approach. It would be Australia's largest coal mine, requiring a new railway line stretching over 200 kilometers and port expansion at Abbott Point to handle the coal exports. Environmental groups opposed the project for its carbon emissions and impact on the Great Barrier Reef, while financial analysts questioned whether coal demand would justify such massive infrastructure investments. Undeterred, Adani pressed forward with characteristic determination, eventually scaling back the project but completing construction in 2021. Meanwhile, Adani's coal trading business grew to handle over 100 million tons annually, making it one of the world's largest coal traders. The strategy of controlling the entire value chain from mining to power generation gave Adani enormous operational leverage, but it also concentrated risk in a sector increasingly under pressure from climate change policies and renewable energy competition. Airport operations represented Adani's most spectacular diversification success, achieved through a combination of debt financing and strategic acquisitions that transformed him into India's airport king almost overnight. In 2019, Adani Airport Holdings shocked the infrastructure world by winning management contracts for 6 major Indian airports: Ahmedabad, Lucknow, Mangalore, Jaipur, Guwahati, and Thiruvananthapuram, beating established players like GMR Group through aggressive bidding that promised higher revenue shares to the government. But Adani's real coup came in 2020 when he acquired Mumbai's Chhatrapati Shivaji International Airport through his takeover of GVK Group's stake, instantly making him the controller of India's second busiest airport. The acquisition required over $3 billion, financed through a combination of debt and equity that demonstrated Adani's ability to raise massive capital even during the COVID-19 pandemic. Within 3 years, Adani controlled 24% of India's air passenger traffic through airports that handled over 60 million passengers annually. The airport portfolio generated steady cash flows less dependent on commodity cycles than his traditional businesses, providing the financial stability that rating agencies valued. His airports business also showcased Adani's operational capabilities beyond pure infrastructure development. Passenger satisfaction scores improved significantly under his management, while revenue per passenger increased through better retail and commercial operations. Data centers and renewable energy became Adani's answer to critics who claimed his empire was too dependent on fossil fuels and traditional infrastructure, launching what he called a green transformation that would require over $70 billion in investment by 2030. Adani Green Energy emerged as one of the world's fastest-growing renewable power companies, with plans to generate 45 gigawatts of clean electricity capacity by 2030, making it larger than many countries' entire power grids. The renewable push was financed through a combination of green bonds, development finance institution loans, and one of India's largest ever follow-on public offerings, which raised over $1 billion in 2021. Simultaneously, Adani launched Adani Connex to build hyperscale data centers across India, recognizing that digitalization trends would create enormous demand for data storage and processing capabilities. The data center strategy required partnerships with global technology companies and over $5 billion in planned investments to build facilities capable of handling India's digital economy growth. Adani's green energy projects spanned multiple technologies: solar farms in Rajasthan covering areas larger than entire cities, wind farms in Tamil Nadu and Gujarat, and hybrid renewable projects that combine solar and wind generation with battery storage. The renewable energy pivot served multiple strategic purposes. It addressed environmental criticism of his coal businesses, attracted international investors focused on ESG criteria, and positioned Adani to benefit from India's commitment to achieve net zero emissions by 2070. The financial architecture underlying Adani's empire was a masterpiece of debt engineering that maximized leverage while maintaining just enough equity to satisfy lenders and rating agencies. By 2022, Adani Group's combined debt exceeded $30 billion across hundreds of individual borrowing arrangements spanning rupee-denominated bonds, dollar-denominated loans, green financing facilities, and complex structured products. The group's debt-to-EBITDA ratio consistently exceeded 4 times, levels that would be considered dangerous for most companies, but were justified by the stable cash flows from infrastructure assets and the group's track record of meeting debt service obligations. Adani's financing strategy relied heavily on pledging shares in his publicly listed companies as collateral for loans, a practice that provided liquidity but created risks if share prices declined sharply. The group maintained relationships with over 50 banks globally, including major Indian lenders like State Bank of India and HDFC Bank, as well as international institutions like Standard Chartered and Deutsche Bank. Credit rating agencies maintained investment-grade ratings on most Adani entities, citing the essential nature of their infrastructure assets and India's long-term growth prospects. The complexity of Adani's financial structure was both a strength and vulnerability. It provided access to diverse funding sources and optimized capital costs, but it also created opacity that made it difficult for investors to fully understand the group's consolidated risk profile. The empire's apparent invincibility faced its greatest test in January 2023, when Hindenburg Research published a report alleging accounting manipulation, excessive debt, and stock price manipulation across Adani Group companies. The short sellers report triggered a market catastrophe that wiped out over $100 billion in market capitalization within days, transforming Gautam Adani from Asia's richest person to a billionaire fighting for his empire's survival. Hindenburg's allegations included claims that Adani had used offshore entities to artificially inflate trading volumes and share prices, that the group's debt levels were understated, and that related party transactions masked financial weaknesses. The report's impact was amplified by Adani's heavy reliance on pledged shares as loan collateral. As share prices collapsed, margin calls from lenders threatened to create a cascade of forced selling that could destabilize the entire group. International investors who had purchased over $2 billion in Adani bonds saw their investments lose 30 to 50% of their value overnight, while Indian mutual funds and retail investors faced massive losses. The crisis forced Adani to cancel a planned follow-on public offering that would have raised over $2 billion, instead focusing on asset sales and debt reduction to restore market confidence. The group's response emphasized that its operational performance remained strong. Ports continued handling record cargo volumes, power plants maintained high availability rates, and airports showed recovering passenger traffic post-COVID. But the Hindenburg crisis revealed how an empire built on debt and market confidence could face existential threats when that confidence wavered, regardless of operational fundamentals. The Adani Empire's legacy extends far beyond the spectacular rise and fall of its founders' net worth, representing both the enormous potential and inherent risks of debt-fueled infrastructure development in emerging markets. At its peak, Adani Group employed over 25,000 people directly and supported hundreds of thousands of jobs across its supply chain, while its infrastructure assets served hundreds of millions of Indians through electricity, logistics, and transportation services. The group's contribution to India's economic development was undeniable. Mund Report enabled Gujarat to become India's largest cargo handling state. Adani Power plants provided reliable electricity to support industrial growth, and the airport acquisitions improved passenger experience while generating revenue for government stakeholders. Yet the 2023 crisis highlighted fundamental questions about corporate governance, financial transparency, and the concentration of critical infrastructure assets in the hands of highly leveraged private entities.
Gautam Adani's approach to empire building, identifying infrastructure bottlenecks, acquiring them through aggressive debt financing, then leveraging success to fund exponential expansion, worked brilliantly in India's high-growth environment but proved vulnerable to shifts in market sentiment and increased scrutiny. The story serves as a masterclass in both the power of strategic vision and political relationships in emerging markets, and the risks of building empires on foundations of debt and market confidence that can shift with stunning speed. Whether Adani Group emerges from its crisis stronger and more sustainable, or becomes a cautionary tale about the limits of debt-fueled growth, its 3-decade journey from diamond trading to infrastructure dominance will remain one of the most audacious empire-building stories in modern business history.